Hello, everyone. This is Sébastien McMahon from IA Financial Group, and I'm here to bring you a new discussion between us and one of our star portfolio managers. So this time, our guest is Jean-Pierre Degnilo. So hello, Jean-Pierre.
Hi, Sébastien.
So Jean-Pierre is manager responsible for the corporate credit here at IA. Of course, we have Clément Gignac, our chief economist that you all know. So hello, Clément. So, all right.
Hello.
So we'll get started with maybe with Clement's opening remarks. We've had a very volatile month of March, but today, as we are recording this on April 6th, on Monday, markets are in a very dark shade of green, so very positive. So, are we finally seeing the light at the end of the tunnel?
So it's a good question, and this is the title of this video, and it's very nice opportunity, and to have that with Jean-Pierre, my colleague and my friend as well. So you know what? I think people like this kind of volatility to have finally some green, but do not conclude that we are out of the wood because yes, market has recovered already. We noticed that it was minus 38% on March 23rd, and now it's around minus 22 from the peak. No doubt it was volatile this March. 4.8% was the average daily change on the Dow in March. This is the highest volatility ever seen if you determine that as of the change on daily basis. 4% during a month, it was worse than even in the 20s and the 30s. So yes, it was a bear market arrived significantly, and do not be surprised that you have a recovery pretty fast as well for the time being. But we need ingredient. Okay, the first ingredient was very important. It was exactly March 23rd when the Fed go as a backstop to help company with a good balance sheet, let's say investment grade, that if you have a problem to raise money, guess what? We are there. So the Fed has never intervened. Really, the market was happy by the move that you have a backstop there. So this is an important ingredient. The second one is the fact that now we have a consultation in the G20, because forget the central banks. This is not monetary policy to save the day here. It's more the fiscal policy. So the unprecedented package that you see around the G20 is so significant. Not to mention that in addition, the central banks in fact reduce the buffer on the capital ratio for the banks, which is exactly the opposite of that was in 2008. So this is bold move, but we need probably another ingredient before calling the shot. Okay, the worst has been March 23rd, minus 28%, and we will not retest that trough. What it will be important is to see continued collaboration. Maybe we can talk about that on the oil sector, because right now people basically conclude that it's done. Mr. Trump gave a bus to Putin and to the Saudi Arabia, and it's done. The deal is not evident yet. So this is a risk factor that we could develop later on. But let's say so far so good. But make no mistake, you will see after the COVID-19, it will not be the same than in the past, okay? Just like 911. It was before 911, after 911, the same thing for me is there. So, but in the meantime, enjoy. But I suggest to be disciplined, okay? Because you will have loser and you will have winner. I will stop here at this stage.
Okay, all right. Maybe now shifting to Jean-Pierre. So everyone that buys diversified funds know that they have stocks and they have bonds, but what they maybe don't understand well is that in the bond part, they have about 30% of that part that are corporate bonds. So could you just explain for the layman out there how what's corporate bonds and how does that market work?
Yeah, of course, Sébastien. Thanks. So, in a simplified way, think of corporate bonds as a way of companies to borrow money, a bit like individuals do, or even governments do. You can borrow money at the bank, but companies can borrow money at the bank, obviously, but they can borrow in public markets. With investors buying their bonds in their public markets. So investors return are based really on two things. One is the rate of interest that they'll get, or the interest payments that they'll get from these companies, and prices of these corporate bonds vary constantly, a bit like stocks do. So they go up and down, and they're traded in a broker market. So basically, what the risk is for investors is basically two things. One is if the credit of a company goes bad, then the price of these bonds go down, obviously. And the other big risk here is if the companies default on paying interest on these bonds, then investors will be saddled with potential losses.
Okay, all right. So since the beginning of the year, how has that market behaved?
Yeah, so the pandemic and crude prices as well caused, as you know, a huge sell-off in risk assets, and corporate bonds did not escape this movement downward. So this past quarter, actually, investment-grade corporate bonds suffered their worst performance on a relative basis versus government bonds in the last 30 years. So in fact, even worse than during the financial crisis in 2008. So just to give you figures, corporate bonds in the U.S., high-grade corporate bonds, I should say, were down on a relative basis 11%, and high-yield bonds, those are bonds that are higher risk or speculative grade. They were down 15% versus treasuries. So closer to home, Canadian investment grade bonds underperform federal bonds by about 8%.
Okay, all right. So, Mr. Gignac, maybe shifting to you. We know that you've worked in Ottawa with Mr. Flaherty in 2008, 2009 during the crisis. So many measures were put in place then. Are you seeing new measures now that were not even part of the solution in the financial crisis?
Yeah, they have two things. The first one is the fact that for the first time in history, Federal Reserve has act as a backstop for companies which have a good balance sheet, let's say investment grade, that if you have any problem to raise money, guess what? We will be there as a last resort if you want. So this is something they have not done in 2008, 2009. Let's say that 2008, 2009, the cause of the recession was more the bad lending practices were fragile. In fact, you have the banking sector who has a bigger difficulty. This one is not the same thing. It's a lockdown, it's a shutdown of the economy. It's not the same cause, this recession. The problem is not the banking sector. This is the real economy, and the companies need money. So this is something that they have intervened. It was a bold move. It was, let's say, on March 23rd, and so far it was a trough of the market as well, minus 38% at that time, the S&P, or the LQD, let's say, it's an ETF on the corporate bonds, and you can use this ETF as a guide. You can notice they have rebounded nicely, and to be honest, we have been aggressive with Jean-Pierre as well, and we have, in our case, diversified funds increase the exposure to corporate bonds investment grade. The second bond move, it's the opposite of 2009, 2010. At that time, they have to capitalize better. So they ask the banks to become more prudent, to raise the capital, cut the dividend, raise capital, because they was not, the capital was too low, the capital base too low. Now it's the opposite. They have the offer to reduce the requirement reserve, the buffer, and it's equivalent to 500 billion now money available for the banks to do their job, which is basically help the companies who need money, because the capital market is closed for many of them, so they need money, and the capital play their role. So this is two things that it's exactly the difference with 2008, 2009, when I was with Mr. Flaherty and the finance department to deal with this crisis and be active in the G20.
Okay, good. Thank you. So that's a very important point, the backstop from the Fed. So JP, Jean-Pierre, do you think that means that we've seen the worst from this pullback in the credit market?
Well, so as you know, central banks have have been serving as a backstop, the lenders of last resort, if you want. But this has provided effectively a lot of confidence in markets and that things won't get out of hand. So it's important to note that the Fed program is potentially $500 billion in firepower. They might even decide eventually to go up the curve and buy longer dated bonds. This will greatly diminish the likelihood of spreads gapping out in a disorderly fashion. So I believe that spreads will settle somewhere in the 200 basis point level. Just to give you a level, before we entered the crisis, corporate spreads were around 100 basis points, so we're double that level at this point. But let's not forget that, yes, things are more positive now, but there remains the overhang of ratings downgrades and potential defaults. But this is mainly a high yield market issue. We know that investment grade corporates, for investment grade corporates, the likelihood of defaults is very remote. So yes, I think that we've seen a cap on spreads here, that the worst is behind us for investment grade corporates, but in the high yield market, we could retest higher levels here, given the volume of downgrades and potential increase in defaults. So we could see more stress in high yield, definitely.
So this is an important distinction that our colleague Jean-Pierre made, because we know in our diversified funds that I manage with the help of Sébastien as well. So we invest in the corporate bonds, but we invest in your funds. But I think you have a very limited exposure to the high yield. Could you elaborate on that?
Yeah. So we came into the crisis with no exposure to high yield, so basically our corporate bond holdings are high quality, mainly in sectors that are regulated and with issuers that have very strong balance sheets.
Okay, good. And this is important because the names that you are investing in are, for most of them, the best part, they are also on the stock market too, so the same companies. So if it's good for their credit, it's also good for the perception of investors towards their equities. So important also for...
And I think as well, Sébastien, that a lot of U.S. companies in the shale oil, for example, are being a lot in the high yield market. Yeah. And this is something that you don't have, Jean-Pierre, in your portfolio. This is what I understood.
Correct. So we don't have exposure to shale producers. We don't have exposure to high yield generally. So portfolios are in good shape in terms of credit quality.
Okay, good. Okay. So you mentioned the Fed. So do you think the Bank of Canada is next and going to be starting to do the same thing?
Well, the market participants have started, I think, pricing in that possibility. As you know, the Bank of Canada has already put in place a number of programs to help alleviate pressure in financial markets, more specifically on funding. So programs exist now to buy commercial paper, Canada mortgage bonds, even provincial money market paper. So we know that the Bank of Canada is actively looking and assessing financial markets conditions. But however, in corporate credit markets, with the very positive tone in the last couple of weeks, issuance has come to Canada in issuers such as Bell Canada and Rogers and TransCanada Pipeline. And there doesn't seem to be any sort of dislocation. In fact, the demand has been huge in the past couple of weeks. Deals have been 3 to 5 times oversubscribed. So there doesn't seem to be any stress per se, but the bank just might be keeping this card in their back pocket in case markets turn take a turn for the worse.
Okay, good. It's a positive sign. So we are April 6th. It's 12:15. So Jean-Pierre, what would be your strategy right now?
So we've headed into this crisis with a fair amount of liquidity and dry powder to be able to buy bonds at higher yields or at higher spreads. And this is definitely what happened. We've seen spreads spike up, and so we had a lot of dry powder actually. And our strategy has been to participate in new issues coming into our market, both in Canada and the U.S. At wider spreads and at huge yield concessions. So that's how we see our activity going forward, mainly in new issues.
Okay, good. Maybe closing remarks. Clément, you've mentioned that you are optimistic, and I share that optimism too. You mentioned about oil being a risk factor, but what would be an alternative scenario now that would make you see things differently?
Yeah, no, it's my branding in the last 3-4 weeks that people find me optimistic despite this unprecedented bear market and what's going on. The market as we speak is probably 20% decline from the top, but it was 38% on March 23rd. So it's a nice recovery. It's a very fast recovery so far, but do not conclude that everything is solved. And because we are not out of the woods yet, to be honest, and we have to work with possible alternative scenario as well that suddenly things could shift, let's say, on a dime, to be honest. I explained. The market right now is encouraged by the fact that, in Europe and in Asia, maybe the peak is behind us and so on and things. But, it will be different. After the COVID-19, it will not be before. And the risk we have right now is they have some issue not solved yet. Let's say oil price, for example, the oil market. So people seem to believe that Mr. Trump has convinced Saudi Arabia and Mr. Putin to have a deal. They will cut by 10, 15 million barrels a day, and the U.S. have nothing to do with that, and that's it. And as a threat, we will go with tariff. But you know what? That sounds protectionism. That sounds the bad experience of the 90s, of the 30s, excuse me, because at some point the market dropped and they have some false start on the stock market. Why? Because some countries go with protectionism at that time. We have noticed what happened with medical device, with 3M last week. And now what's going on in the oil market? Is it possible that the U.S. will go with tariff to protect the shale oil industry? If you have this kind of stuff, disagreement regarding what to do, each protectionism, in some case I could understand, but really if you go protection sector by sector, it's exactly the opposite of the globalization that we have enjoyed and seen over the last 3 decades. And notice the contribution of emerging countries, it was due to globalization. So emerging countries will suffer big time if we go nationalism, protectionism, and that will affect the potential GDP that affect the global market. So I really watch very and continue like today. Don't be surprised. In fact, adopt an underweight equities or network to scale down. Do not any time to panic on March 23rd at -8 and now jump in all in the market because you could have something. I suggest to be disciplined, and when you have a 8 days, take some profits. And doom and gloom again, maybe timing again. So, but I will watch the next G20 meeting and possibly the oil market as a missing ingredient to support this recovery.
Okay, good. So thank you for that. Risk management is the name of the game, of course. So thank you. Wise words here. So thank you very much. As you can see, we use the means that we have at our disposal during this lockdown period. So thank you very much for your collaboration. Thank you, Jean-Pierre, for taking the time to discuss this with us today. So thank you very much.
Thanks for having me.
Thank you again, Clément, for all of this. So everyone out there, thank you for your support. Thank you for your trust. You can always go at ia.ca/economy, find everything that we produce out there. So in the name of everyone, I want to thank you personally, and thanks again to our panelists here today, and we'll see you in a few days. Thank you.